Series of training in 2026 that we're calling the IUA's Underwriting Essentials series. These training sessions are exploring underwriting fundamentals relevant to practitioners across all classes of business. If I haven't had the chance to meet before, I'm Tom Hughes, the Director of Underwriting at the IUA. And in case you haven't come across the IUA before and this is your first interaction with us, we are the trade association for the company market in London, representing 80 insurers and reinsurers. We run committees day to day, bringing together practitioners from across almost all classes of business to discuss common issues and promote good practice. Now, one such committee, and it's an important one for the purposes of today, is our newly formed Chief Underwriting Officer CUO Council, and that group is steering the way on this Underwriting Essentials series. Now, before we get going, I'll take the opportunity to highlight some of the upcoming events that we have. Our events manager, Deborah Finch, will send on some details after today's session, but I've highlighted the Underwriting Essentials series, which might be particularly important for you to mark in the diaries. You can also find the details of the events on the IUA's website, and if you follow us on LinkedIn, we're regularly sending details of the events around. Now, if you've missed any of our events, for example, the first session in this Underwriting Essentials series, which was on lead and follow roles, the remote training sessions that we provide are very often available to watch on the IUA's YouTube channel. So have a look at those and you can pick up the content there. So what are international insurance programs and why are we talking about them today? Well, the London market is very widely recognised as the home of complex, large risks, and those risks are frequently global in nature. So understanding the purpose and the structure of international insurance programs designed to provide insureds with holistic coverage solutions is absolutely essential. Now, before I introduce the speakers that are going to take us through this very interesting topic, I just want to let you know that we have set aside a little bit of time at the end of the session for questions. Hopefully, you've already spotted the Q&A facility within the platform. If you have any specific technical questions related to Think, we will have a look at those, but it may be best to take those after the session, accompanying them with some materials related to the IUA's financial interest clauses. And just to say, if you're thinking of taking notes as you go, please do, but we will be sending around the slides of the session and we are recording as we go. So to lead our session today, we've secured the expertise of two very familiar faces to both the international programs and IUA communities. We have Praveen Sharma, Managing Director at Marsh, London, and Chris Crane, who is Legal Director at Wikborg, Rein. What I'll do now is hand over to Praveen with my thanks, and we'll get going with the session.
Thank you, Tom. Let's get moving in the interest of time. So just so that everyone is familiar with my background, I am a chartered accountant. I'm not a broker, or underwriter, or risk manager. And the views that I'm going to express are my personal views and not necessarily those of Marsh. And we are not here to give you tax and legal advice, but to share my experience of dealing with multinational companies around the world on their global program structure, design, premium allocation, and taxes. So the agenda is very simple. I want to address certain misconceptions that I've come across based on my conversations with risk managers, insurers, and brokers around the world, and then address some regulatory conundrums that multinational companies face, and so do the insurers. But I also want to address some taxation issues, not just premium-related taxes, but potential corporate income tax issues that affects our multinational clients more than it does the insurer. I just want to go through, and I don't wish to, be patronizing here, but just go through certain program options that I've seen around the world that may be pertinent to certain people in the audience. And then, obviously, the financial interest cover clause is the main issue here that we need to address. And between Chris and I, we will address the various issues around that. And then, obviously, Q&A. So moving on, to the misconceptions, and in the list on the next slide, uh, it gives you certain quotes. These are quotes given to me at various meetings by either risk managers, insurers, or brokers. And you might relate to some of these. And I pick on some of the important ones, and you can read the rest yourself and send me an email or whatever with any questions that you may have on these quotes. But the most frustrating part that I've come across is that people think that their global program is compliant if they just have local policies of any limit in every country. That is not true. The local policy is only compliant up to the local limits. The master and the excess policies may not be compliant in many countries where non-admitted insurance is strictly prohibited by law. A lot of clients and tax departments of clients think that a global insurer is licensed in every country and therefore should be able to pay claims from the master or the excess. That is also not true because many insurers have local licensed subsidiaries, but they are part of the same brand, but doesn't make it that the UK insurer is licensed everywhere in the country. Again, that's a misunderstanding that people focus on the brand names rather than the actual legal entity of the insurance company. And the third one is the most frustrating one as well for me, is that the insurance laws of the various countries are being interpreted by different insurers in different ways, such that clients are confused, multinational companies and so are the brokers, as to who is right. And a lot of people say to me, well, the insurer is responsible, I must be right. But I have found in many cases that the insurer is not right about regulations and taxes. And I'll give you a few examples later. The broker or insurer is not responsible for remittance of all taxes. It can be in certain countries where non-admitted is permitted or not prohibited, that the insured is responsible for paying the taxes. The allocation process is a joint responsibility to ensure that the premiums are allocated using just and reasonable basis. And just to cover the final bit, the fin clause is the final one that is pertinent here. It is at the moment inconsistently worded. Many insurers have their own wording, and Chris will address those issues of inconsistency. And people think that it's not been tested. Well, it has been tested in the Adidas case, which I will go through later. But the fact that it's not been tested either maybe because there hasn't been a big issue that the court need to decide upon, and the insurers have settled the claim, or whatever. So these are the certain misconceptions around global programs that can be frustrating for multinational companies and the brokers alike, and as well as insurers. So moving on to the regulatory aspects, there are some examples that I will address. But regulations are quite diverse and inconsistent, but you know that. But what is also diverse and inconsistent is the interpretation of the same law by the insurer's legal department and compliance department. And from my perspective, I'm looking at an insured, a multinational company. Is it allowed by law, or it is not prohibited by law to procure insurance from a foreign insurer? Taking UK as an example, there's nothing in the legislation that prevents a local entity from procuring insurance from a foreign insurer on a non-admitted basis, as long as it's not a compulsory class of risk. It's the same in the US, in Canada, Chile, Peru, Colombia, South Africa, Saudi Arabia, Australia, New Zealand, Thailand, and so on and so forth. And they are in green. But many insurance databases, companies' databases, they sometimes say US non-admitted is not permitted, or Canada non-admitted is not permitted, which is incorrect, and India non-admitted is permitted. So if I go through the next few slides of the actual legislation, Uh, if you look at the legislation of, say, India down below, it's in two parts. And it's not in the insurance law, but in the foreign exchange management insurance regulations. And it's in two parts because it refers to one saying the property must be insured with a local insurer. And the second part is any other general insurance policy must be issued uh, with a local insurer, or if you're going to go to an overseas insurer, you need permission from the regulator and the central government. So technically, most insurers will say non-admitted insurance is strictly prohibited and you can't cover the risk in India on a non-admitted basis. It has to be on a think basis. So the laws of other countries like China, Argentina, and on the next slide, you can see also countries like Japan and Mexico and South Korea. They all say non-admitted is strictly prohibited. So what the conclusion is that these countries, as a minimum, should be included on as a think basis and not on a DIC-DIL basis. Because technically, if you're covering the risk in Japan in contravention of Article 186 or in India, then you could be in breach of insurance regulations, and there could be some ramifications for both the multinational companies and the insurers. Now, the regulations being regulations, the taxation issues on the next few slides, I just want to highlight the premium tax issues. The premium tax landscape is not becoming easier for multinational companies. Two reasons. One, the tax authorities need tax revenues. And so on the right-hand side, you can see the table. I joined Marsh in 2008, and now in 2026, nearly 17 years later, just about every country's tax rates have increased, except for Ireland, where they have decreased by 1%. Lithuania is the latest country to join the premium tax regime, and it's introduced a 10% tax. Slovakia has increased its tax rate this year from 8% to 10%. And there's a rumor still out there that UK could also increase its tax rate from 12% to maybe the same rate as the VAT. But let's wait for that one from the Chancellor. But at the end of the day, the second part is where the tax authorities are doing audits, proactive audits in Switzerland, in Germany, in Belgium, in Canada, and they audit the insured and want proof of payment of any premium-related taxes because the risk has been covered on a non-admitted basis by a foreign insurer. And in countries like South Africa, Australia, New Zealand, US, Canada, Taiwan, Thailand, where risks can be covered on a non-admitted basis, the insured is responsible for paying the taxes. So these two issues can affect the total cost of risk for the client and multinational companies. Now, moving on to the next slide, the premium tax laws, various countries, particularly those in the EU, state that the premium tax is payable on the location of risk. Now, the location of risk is frequently misunderstood by the industry, and it's not where the event might occur. It's where, for instance, property and assets or stock, it's where the property and stock is located. This is in the EU Second Non-Life Directive and in the Solvency II Directive and in the tax legislation of many of the EU members' tax legislation. For liability classes of risk like D&O or general liability, the risk is located where the establishment to which the policy relates to, and that means subsidiaries and branches. So for D&O, frequently people think, oh, where is the director based? So it might have a German company or a UK company with the director sitting in Cayman Island. The risk is not in Cayman, the risk is in the UK because the establishment to which the policy relates to is actually located in the UK. So, excuse me. So it's important for you to understand the locational risk rules to determine what premium taxes should be payable. And tax authorities expect the premiums to be allocated using just and reasonable methods to say, because the insurer in the EU and UK is responsible for collecting the UK and EU IPT, it must be done on using relevant factors that is pertinent to the risk and is credible and verifiable. Now, if in the next slide, if the program is not structured according to the business model of the client, the multinational company, there could be quite a severe adverse income tax implications. So this very simple example, I've simplified it. This is not for tax people. This is for the audience here. Is that if a client has a potential master and excess policy of 50 million limit and has a potential risk in, say, China of 15 million, but they choose not to buy a local policy of 15 million. And like my misconception, people think, oh, if I buy a 1 million local Chinese policy, then the 50 million is more than adequate. Well, no, the local insurer will only pay up to a million loss if there's a 11 million loss, and the master insurer will pay the 10 million difference to the parent company. The parent company will suffer income tax of 2.5 million. And then when they want to transfer the money to China, there could be all sorts of implications. The Chinese tax authorities could argue that this money is gift income and should be taxed again. So there could be double tax implications for this. So it's important on the next slide to ensure that the program is fit for client's purpose. And in this regard, there are various ways that I have seen the insurance programs being structured. There could be one single global policy with no local policy limits or policies issued at all, like the master policy itself, the excess policy itself is a single global policy that covers the risk outside the UK on a non-omitted basis. And that could create issues for both the insurer and the insured. So there are lists here of the pros and cons that you can have a look at. The next slide is where I have seen it's a decentralized operation. Everybody buys their own local policies and limits, and there is technically no master, or there's no commonality and synergies and economies of scale. And that could create its own issues in terms of gaps in cover and total cost of risk. The third one is the one that we are all familiar with, is the control master program with Dick, Dale, or Fink clauses. And this basically harmonizes the potential gaps in cover, the total cost of risk, and ensuring consistency of wording and everything else. But pictorially on the next slide, I can just show you the what it could look like is that you're arranging local policies equal to expected or probable maximum loss in every country, even within the European Union. Say, for instance, Spain is to do with consortia charges, France might be Gariat, and Italy might be something similar as well. And then in countries like Turkey, China, Brazil, we don't have a crystal ball to get this right. So we need to make sure that the local policy limit is as close to as foreseeably possible to estimate the losses depending on the size of the activity and the nature of the activity. You buy a Manhattan Skyline type of a local policy program. Then, just to have a sleep easy policy, you have the master Dick Bill with Fink clause, and then the excess tower is catastrophic risk that ensures that any unforeseeable losses that we just could not predict at least is covered on the excess tower basis. So then we say, well, what is Fink? So let's go on to the Fink clauses. And the purpose of the Fink clause on the next slide is to just protect the insured and the insurer from the regulatory issues. It is not going to address your tax issues. And then it basically makes sure that the subsidiaries that are located where non-omitted is strictly prohibited by law are not insured, but the insured is the parent company, And the overseas subsidiary has no beneficial rights under the master in the excess, and the parent company is going to receive the claim monies for its financial loss as a result of a subsidiary suffering an uninsured loss that will be subject to income tax. So think must be used as a matter of absolute last resort, not the first, last resort when you've exhausted all possibilities, because the implications of think in the next slide can be a double-edged sword. So on the premium side, any premiums that are allocated to the subsidiary in China, India, Brazil, are going to be subject to UK premium tax because the financial loss risk is located now in the UK. They cannot be recharged internally by the client because the subsidiary is not insured and must not be paying the premium. And then such premiums should be eligible for corporate income tax relief in the UK tax computation. But more importantly, the client needs to understand that the claim monies will not be paid to the foreign entity because it is not insured and has no beneficial rights. The claim monies will be paid to the UK parent. And the claim monies will be subject to corporate income tax because claim monies are not tax-free income. And then the foreign subsidiary may be able to claim tax credit for the uninsured loss. There are various issues that need to be considered because if the parent wants to transfer the money to the overseas subsidiary, how does it do it? It can't be transferred by way of claim monies. It can be only transferred by way of capital injection or loan or whatever. That creates transfer pricing issues for the client. There are corporate finance issues and KPI issues for the client, and there are potential, income tax implications for the subsidiary as well. So there's potential for double taxation. And then, D&O is one other thing that cannot be covered. So very quickly, moving on to the misconceptions, you can read this slides yourself. Technically, think can be used as a matter of last resort, has been tested in court, and I will address it in the next slide immediately. And then the question is, you should consider a local policy if there is an exposure. If you've got one man and his dog operation, then maybe, and there is low risk for it, there's not even a need for a local $1 million policy. So let me go through the Adidas case study for those who have not heard of it, what happened. On the next slide, just lays down the facts. And the facts are, waiting for the facts to appear. Next slide, yeah. So what happened in Adidas case in 2009, Adidas has a subsidiary in India called Adidas India Marketing P Limited, and it insured its local risk of stock and fixed assets under a local policy up to 7 million euros at cost value. Adidas Germany had a master policy that covered it for anything excess of 7 million with a FINC clause in it. There was a financial interest cover clause issued into the master, and the premium that was notionally allocated to India was not internally recharged. In 2009, unfortunately, the whole stock and fixed assets got burnt down, and they suffered a total loss of 21 million euros. 7 million was paid under the local policy. The 14 million was paid under the German master to the German parent company for the financial loss that it suffered. The claim monies was taxed in Germany at the German corporate income tax rate. Okay, but on the next slide, the Indian tax authorities argued that the German master policy was also covering the stock owned by Adidas India, and that various email internal correspondence seems to say that the compensation that was received by Adidas Germany belonged to Adidas India, and that the claim monies that Adidas Germany had received was basically for the benefit of Adidas India. And that, most importantly here, they argued that the German master with the Fink clause was a tax avoidance tool. Okay. 10 years later, the tax tribunal, came to the conclusion, and I was very impressed with the fact that they had gone through the Fink clause as I had been supporting Adidas on this case, according to my interpretation. So it was good. Basically, they argued, they held that the local policy was covering the tangible asset, whereas the master policy was covering the intangible asset, which is the economic interest, and that these two policies were distinct and separate, and that Adidas India under the Fink clause had no rights to receive the money because it wasn't insured and had no beneficial rights, and that the Fink clause was not tax avoidance scheme. So, in conclusion, from my side, what we want to make sure is that we structure the program that is fit for client's purpose, and in terms of ensuring that the program is fit for their purpose and follows their business model, to see what they're doing, why they're doing it, where they're doing it, what are the various ways of covering the risk, and please don't offer just a standard $1 million, €1 million, £1 million local policies without giving due consideration to the actual potential exposure. Consider the premium allocation methodology. There's just not one way of covering the risk, allocating the premiums either. But it needs to be just and reasonable and defensible. And then the premium tax liabilities that the client has to pay either under the local policy or under the master or the excess is properly identified, and which is what I do for many, many multinationals around the world. So that's from my side. Over to you, Chris, to elaborate further on the Fink clauses.
Thanks, Praveen. And good morning, everybody listening. So I will now outline the key features of the financial interest clause and how they're generally intended to operate. Just to set the scene, and at risk of repeating a little bit a few points of what Praveen has already mentioned, the main purpose of the Fink clause is to help insurers and insureds comply with local laws in countries where global insurance policies aren't allowed. The key principle is simple. The subsidiaries in the country where non-admitted insurance isn't allowed are not covered. Instead, the clause covers the parent company for the financial loss that it suffers when an uninsured subsidiary has a loss. And the amount payable is based generally on what the subsidiary would have received if it had been insured under the policy. So just the key point, the cover is for the parent's financial loss, not the subsidiary's loss directly. And just to repeat what Praveen said, it's an important message is that the financial interest cover should be used with a high degree of caution and as a last resort to provide cover in specific circumstances where the nature of the cover has been carefully considered and understood by all parties. It will not be appropriate for all situations. For example, it's not appropriate for Side A D&O cover, and it should only be used where the insured parent has a genuine financial interest in the uninsured subsidiary. So turning to the structure of the clause, there is a diagram on your screen, which is intended to illustrate what is and is not covered under a financial interest clause. So the heart of financial interest cover is a clear identification of countries where the global policy cannot provide the cover required. And that could either be because the insurer isn't allowed to operate there or because local companies aren't allowed to buy insurance from foreign insurers. And that area is indicated in the red dotted box. So subsidiaries in these countries and any losses or liabilities that they suffer are not covered under the global program. Instead, the financial interest clause is intended to provide cover to the loss that the parent suffers to its economic interest when the uninsured subsidiary suffers their loss that would otherwise be covered by the policy, and the loss that that the parent suffers, which is shown in green, is intended to reflect, using the policy or the endorsement terms, is intended to reflect the amount that would have been recoverable by the subsidiary under the master policy if it had been covered. But again, just to restate, the key point is that there's no cover for the subsidiary's loss, damage, or liability, only cover for the parent's loss of financial interest, which is deemed to be equivalent to that subsidiary's loss. So moving on, we see that there are some key points that should be addressed in every financial interest clause. May sound obvious, but the clause must clearly identify who is and who is not insured. In most cases, this should be straightforward, but where cover is for a multinational corporate with complex organization and structure, care will be needed to make sure that the named insured in the financial interest clause has a financial stake in the uninsured subsidiary, either directly or through subsidiaries in the chain. Equally, it's important to be clear and specific about which countries are covered on a think basis. So best practice would be to list those countries in the risk details so that there's clarity, and that will also ensure that there's consistency as between co-insurers if cover is provided on a subscription basis. The policy should also expressly confirm that the parent has a financial interest in the subsidiary because it benefits either financially or economically from the subsidiary's success, and it would suffer from if something went wrong. And this is intended to reflect the English law test for insurable interest and removes any doubt as to whether the parent has a genuine financial stake in the subsidiary. Turning to the scope of cover, the insuring clause will provide that the insurer agrees to pay the parent for its financial interest when a subsidiary suffers a qualifying loss. And a qualifying loss is generally defined as being one that would be within the scope of the master policy if it had been suffered by the parent itself. You should look closely and carefully at the trigger for cover. Does cover follow automatically following the subsidiary loss? Or does the parent have to prove that it has a financial interest in the subsidiary? Or does it even need to prove that it has suffered the economic loss itself? All of these things should be carefully looked at in the insuring clause. The amount that the parent is then entitled to recover is calculated by an agreed formula. And this is generally done by reference to what the subsidiary would have received if it had been directly insured under the master policy on the same terms. And then that amount is then reduced by any recoveries that the local subsidiary receives from its local policy and from any third-party recoveries that it's able to make. An important consideration for any financial interest clause is whether or not to include a scaling provision, which reduces the value of the indemnity in proportion to the parent's ownership in the relevant subsidiary. The IUA model clause deliberately didn't include a scaling provision, as the view in the drafting committee was that it can introduce a degree of uncertainty in terms of how the proportion is proved, And it all can also introduce and create inconsistencies with other parts of the program. But it should be noted that it may be appropriate to include a scaling provision if the subsidiary has a low the parent has a low ownership ratio for the subsidiary. Moving on to policy terms, an important point to be aware of is that the local policy will not be party to the local subsidiary will not be party to the policy. So it will not then be bound by the general terms and conditions which apply to all other subsidiaries that are parties to the policy. So the fin clause should include provisions that make sure or finds a way, uses mechanisms to ensure that the subsidiary adheres to the terms and conditions of the policy. In the case of the duty of fair presentation, this will usually be done by deeming that the parent knows all material information that is known to the subsidiary. And in the case of warranties and conditions, by implementing a mechanism whereby the parent becomes or is responsible for ensuring compliance of the terms by the subsidiary. Finally, onto claims, the fin clause should have clear provisions that address how claims will be processed. There are two overarching considerations here. First is again that there's no privity of contract between the insurer and the subsidiary. And second, the insurers will often be prohibited from engaging in claims activity in the non-admitted territory with respect to the loss suffered by the subsidiary. So the clause will need to include provisions which channel information through the parent and clarity as to the appointment of loss adjusters and investigation of the claim and so on. By far and away, the most important point is that claims payments can and must only be paid and made to the parent and not to the subsidiary. As a general rule, the insurer will only be subrogated to the rights of the insured parent and not those rights of the uninsured subsidiary. And so the fin clause should therefore include provisions to reflect how any potential rights of recovery that the local subsidiary may have against third parties may be assigned to the insurer. And so I think that was my very rapid whistle-stop tour through the anatomy of a financial interest clause. I'll just finish by pointing you in the direction of the IUA model endorsement that can be found on the IUA clauses library. With that, I'll hand back the reins to Tom for the Q&A.
Thank you very much, Chris. And it is an opportune moment to mention the fact that across all classes of business, the IUA produces model clauses and wordings that market participants can choose to adopt, to amend, or to ignore as they see fit and as best suits their circumstances. We have a clauses committee made up of senior wordings practitioners. It also has broking representation on the group, and Chris Crane is our legal representative. So we are very well resourced and able to produce model clauses and wordings applicable on a cross-class basis. Now, there are a number of questions all coming through at one time, which is often the case when we get to the end of the session and into the Q&A. But as you just mentioned, the scaling provision, Chris, and of course, Praveen, feel free to hop in on any of those of these questions as we go. If there is no scaling provision, then why do we say that the policy only pays the parent's interest in the subsidiary? Without a scaling provision, the parent would be receiving more than its interest.
Sorry, just unmute myself there for a sec. Praveen, were you about to jump in?
No, because I was waiting for you to go first. I know the answer to this, but
Well, why don't you
I want
take it
to.
first?
Well, okay, I'll give you the practical answer. And this also addresses somebody else's question about uncertainty. The point about this is that when I've been involved with think clauses for the nigh on 20 odd years, right? And when the first time the think clause was started many years ago, 2006, and I was involved in it, many multinational companies, risk managers said, aha, if I own less than 75%, you're going to reduce the claim monies that I will receive. So I don't want the think clause because under normal Dick Dale provisions, you'll pay me the total loss regardless of my shareholding. And now you're trying to reduce the claim monies by saying that I own less than 75% because 75% was being used as I don't know why. If you the wording talks about subsidiary, then a subsidiary could be anybody that is less than 51%, even depending on the economic interest that the parent has in that, because there may be a silent partner in a particular country, but the parent company has the bulk of the potential for the loss. So that's why the scaling provision can actually reduce the amount of the claim when the parent company has the potential for suffering all of the loss. And that's why the think clause that the IUA use is talking about the economic interest, because a parent could have 1% shareholding and could suffer 100% of the loss, and it could have 75% shareholding and may have the same type of loss. So that's why the scaling provision was not used in the IUA model. Chris.
I'll just add a couple of points. The first is that if there is a scaling provision and any losses, it has to be reduced in accordance with the ownership proportion. That does introduce a potential area of dispute as to what is the precise amount that should be reduced, and so that can introduce a degree of uncertainty as to recovery of what may be considered excessive recovery. You have to take into account that when there's what is attempted to be done through the financial interest clause is to produce a mechanism which allows a valuation of the loss to be suffered, an agreed valuation of the loss to be suffered by the parent. In many cases, the parent will not, in fact, actually suffer a loss. And if you include a scaling provision, then you are also introducing a question of, does the parent have to prove the actual loss that they have suffered? So having no scaling provision means that you can cut through and it's a lot simpler. The parent simply has to establish that the subsidiary has suffered a loss, and then the amount that the parent is entitled to recover is measured by reference to that loss.
Mm. Yeah, I think you hit the nail on the head there with the term simplicity, Chris. And I think it's both the beauty and the challenge around model clauses is that we try and deal with as many circumstances as we possibly can, but there might be some instances where it's necessary to amend the provisions. And there's a rule here for all model clauses when they're being used. If you are amending them, make sure that there is a reference to the fact that they are amended next to the clause code at the bottom of the clause or the wording. Now, we have a question here. Is it an acceptable practice to add a financial interest clause without having local policies arranged in non-admitted countries? Praveen, do you want to pick that up?
Yeah, I mean, the point about the local policy is that it allows the local insurer to adjust the loss, handle the claim monies, or whatever. And if there is no local policy, for whatever reason, uh, but the exposure is significant, I would argue that you should consider still a local policy, even when non-admitted is permitted. But if you've got a one man and his dog operation in Argentina, what's the point of issuing a local policy? And you can cover it under the FIN clause, because the cost benefit of issuing a local policy for minimum premiums plus taxes and everything else, you might as well cover it under the FIN clause, because the loss probably will fall under the group deductible anyway. So you need to be commercial about it. FIN clause can be used, but must be used only as a matter of last resort, as I said earlier. And you don't need to use FIN clause. You don't need a local policy to have the FIN clause. The FIN clause is only addressing the master policy, and that's it.
Mm. And Praveen, if a broking representative specifically asks for a global controlled master program without local policies for a client with local exposure in those countries, how would you expect the insurer to deal with that situation?
Well, if the risk is based in a restricted country like India, Japan, China, Argentina, and the broker says, don't arrange a local policy, we'll cover it under the UK master, then you have to protect yourself and say, I'll cover it under the FIN clause. But then, under the FIN clause, you have to have the clause to say who's going to manage the claims, who's going to deal with the subrogation, how's going to be valued, all those kind of things. So if it was, a broker that comes to me, I would say, what's the reason behind not having a local policy? Is the exposure significant? It's a professional indemnity or a general liability, big factory operation. Why would you cover such a large exposure just on a FIN clause? Because the income tax implications going to be far bigger for the client than any premiums you might pay for local policies.
And Praveen, when we have instances where the local regulation does not explicitly mention the enforceability of Dick Deal from non-admitted insurers, does it mean non-admitted is permitted?
No, both of them are wrong. No insurance legislation, I've read hundreds of legislation around the world, says anything about Dick Deal. Okay? It is a fallacy and a misconception that people think, legislation does not allow Dick Deal or does allow Dick Deal. Doesn't say. It talks about contract of insurance being issued by a licensed insurer. So if you just look at your own UK legislation, it does not specifically prohibit an entity from procuring insurance from a foreign insurer for non-compulsory classes of risks. So our own legislation does not prohibit specifically. Is it permitted? No. It doesn't say it is permitted as well in the legislation, but because it's not prohibiting, I use the word it doesn't prohibit an entity from procuring insurance. Does that make sense?
Yeah, it does, and I'm fast being reminded of the benefit of having experts in different jurisdictions in tax and regulation on hand, because you can see by the very nature of global programs there are complexities that have to be very carefully thought out. Now, Praveen, another question that I think probably falls within your remix. There's lots of tax and regulatory focused questions. The UK has lost a passporting right following Brexit, so is providing DIC DIL cover to EEA countries against the UK regulation.
No, it's not against the UK regulation. It's against, say, the French regulation.
The local
It's
regulation.
against the Spanish regulation, because if the subsidiary is based in Spain and is being covered on a non-admitted basis under the UK policy, why? When most of the global insurers have dual licenses and dual stamping process. So Lloyd's would stamp it twice. They'll cover the Spanish risk via Lloyd's Brussels and UK and rest of the world risk by Lloyd's of London. So you have that provision. So it's very rare that I've seen a EU risks being covered on a non-admitted basis under a UK policy. Most UK insurers, if not all of them, will dual stamp it. But It's the legislation of France, Spain. If you go back to my diagram, you will see that most of the Mediterranean countries, non-admitted is strictly prohibited. France, Spain, Italy, Greece, not Greece, sorry, and various Eastern Bloc countries. Whereas the Scandinavian countries, including the Germanic countries, they allow non-admitted insurance. So you could cover the risk in Germany under the UK policy, but then there are premium tax implications for the insured to deal with by itself. But then, so there's a licensing issue, commercial issues, and then tax issues.
So should the master policy always be issued in the country where the parent company is based, even if the parent company has no function to place insurance for the group companies?
I'm just dealing with exactly that case where the parent company is just a brass plate, and the main subsidiary is based in one of the EU member states. And I'm saying no, the EU subsidiary has no insurable interest in all the other group companies. So having a fin clause in a subsidiary's master policy is meaningless. It has to be at the parent level. So if the parent is in the UK, even if it's a brass plate, the policy should be issued to the master because that has an insurable interest in all the group companies anywhere in the world. And so the fin clause then could go into that UK master.
Got it. Okay, and then it's a real quick fire round here, isn't it? So can an operator purchase insurance through Think covering interest in their subsidiary and joint venture partner interest?
Yeah, that's the Chris. That's a conundrum that we addressed during the wording discussion. How do you address the JV partner's interest when JV partner is not the parent insured? And the fin clause is issued in the master policy, issued to the policyholder. And if there is a JV partner also as an additional insured, if the JV partner is based in India because it owns a minority shareholding or whatever, how do you cover the Indian entity? So if you cover that Indian entity under the UK master on a think basis, the claim will be paid to the UK parent, but the amount relating to JV partner is stuck because it can't be transferred to the Indian JV partner. It's always a conundrum. That's why I've got, that JV is an issue on multinational programs.
Mm.
Sorry, I can't, there's just nothing that.
Chris, did you want to add in on that?
Yeah, in principle, it can be, but it's subject to the challenges regarding onwards transmission of claims, payments, and so on. In the IUA clause, we, as Praveen just mentioned, we thought long and hard about this, and we, in the definition of the parent insured, we sort of piggybacked on what the defined term, sorry, subsidiary, the defined term is for the covered parties in the main policy. So if the JV would be covered as a co-assured under the main under Dick Dill under the main master policy, then it can equally be covered as its financial interest could be covered under the fin clause.
Yeah.
Except that if the JV, Chris, is based in a country where anonymity is not permitted.
Okay, yeah, quite.
You couldn't put it. Yeah.
So sticking with easy questions, sanctions. We did talk about actually in the working group some time ago. So how would the situation be dealt with if the subsidiary is now located in a sanctioned area or country?
Yeah, that's a very interesting question, Tom. Especially given the war situation in Ukraine, that's when I first came across sanctions and being applied in, say, Russia or whatever. So my view is this, and this is my personal view, and Chris, you being a lawyer, you can address it from a legal point of view. The master policy is issued in the UK. The think clause in the master policy is in the UK. In Russia, just take Russia as an example, yes, because sanctions apply, no insurer can provide cover or reinsurer can provide cover to the insurer or the insured in Russia. Fine. So no business activity can be done by the insurer in the UK in Russia. But the Russian entity must insure itself using a Russian insurer, English RAC or whatever, right? The dictail element can still be covered under the think clause. So if the Russian entity that has an insurance of, say, $10 million and suffers a $12 million loss, it does still impact the UK parent's investment. It's the same with political violence. So on that basis, the claim will be paid in the UK, will be invoiced in the UK, and everything, all of the activity will be done in the UK. So I'm sorry, but sanctions is not going to be an issue if you do it on a think basis. That's my conclusion.
Chris, do
Yeah,
you want to make a very brief point before I wrap up?
no, I tend to agree with Praveen, but just to urge caution that in all situations you'd have to look at the precise sanctions legislation that is concerned. So, but conceptually, I agree with Praveen.
Okay, well, it really has been a whistle-stop tour in the last hour over a number of certainly challenging and complex areas of insurance coverage, but very important for underwriters to be aware of these concepts and international programs. And I think actually to start exploring them in a little bit more detail if you're just coming across them. I think we had 20 questions and made it through 14. We just had another one in, but with the outstanding questions, we will be able to take those away after the event and have a think about them and share whatever we can via the IUA's events manager, Deborah Finch. And it is also worth drawing your attention to a session on the IUA's YouTube channel, which we call Global Insurance Adventures. And actually, that was with Chris and the IUA's Clauses Committee about a year ago. And we did provide an introduction to global programs there. So that content is available. Now, the last thing for me to do is to thank all of you for signing in. We had a good few hundred people join this session, which is fantastic, and it's great to see the popularity of the Underwriting Essentials series, and we'll certainly continue to provide sessions through this year. All of that information will come via the IUA's Events Manager. You can find it on our website, and if you follow us on LinkedIn, you'll receive updates there. And of course, what I need to do is to say a final thanks to our two speakers, Praveen Sharma and Chris Crane, who have done an exceptional job in packing as much content as you did into the last hour. So thank you both very much. And I hope everyone has an enjoyable rest of the day and we'll catch up at the next session. Thank you very much.
Thank you.